Hi there, good afternoon, everybody, assuming it is the afternoon when you're watching this. Welcome to NPLs, excuse me, What's Next? It's great to be here to moderate what is obviously a very relevant session today, probably even and ever more relevant in the near to even to medium term. And I'm especially pleased to be joined today by a great panel to talk us through some of the issues we're all facing. My name is Nigel Houghton. I'm managing director at the Loan Market Association. We kind of are born of distressed, if you like, from way back in the sort of the mid 1990s, many moons ago now. Before we kick off properly, please, my fellow panelists, if I could ask you please to introduce yourselves, starting with Alessia.
Thank you, Nigel. Good afternoon. I'm Alessia Pirolo. I'm head of NPL coverage at Debtwire.
If we can now go on my screen directly up to Inigo.
Hello all, good afternoon. I'm Iñigo Rubio. I'm a partner at the finance team of Cuatrecasas González Pereira, an Iberian law firm based in Madrid.
You.
Thanks, Inigo. Over to you, Eric.
Good afternoon, everyone. I'm Eric Cloutier. I'm managing director at KPMG Ireland. I head the regulatory team for banking.
And last but not least, Timur in Frankfurt.
Good afternoon. My name is Timo Peters. I'm managing director of the Debitos GmbH. Debitos is a NPL transaction platform located in Frankfurt. Thank you.
Thanks, everybody. So, yes, NPLs. This is a leverage finance conference, and we're talking about NPLs. What are we actually talking about? Well, NPLs obviously stands for non-performing loans. It is kind of a catch-all umbrella term, if you like, covering various loan asset classes, from corporate to consumer loans, commercial real estate, through residential real estate, shipping finance, project finance, other structured finance. All of these loans may well be syndicated credits, i.e. provided under the same terms by a whole host of different financial institutions, or indeed they may be bilateral loans from one lender to the ultimate borrower or group of borrowers, as the case may be. One thing in common that they do have is that they are branded, if you like, or classified as non-performing. Well, what do we actually mean by non-performing? Well, I had a look just prior to this session, been feverishly taking notes. The ECB, European Central Bank definition, suggests a benchmark, if you like, of 90 plus past days past due in terms of interest and or capital payments. However, they also put an or importantly, loan assets which are considered to be impaired under financial reporting standards, IFRS standards, or indeed US GAAP standards. Now, without going into technical detail about what IFRS standards suggest, impairment, there are various sort of, suggestions, if you like, in terms of what impairment might include. It is indeed what you might deems to be fairly obvious, as in default and so on, but also includes rather less obvious bright lines, such as the borrower being in significant financial difficulty, whatever that might mean. Breach of contract, clearly that's a bit brighter in terms of delineage. But waivers of terms then being in place or under negotiation, which would otherwise have led to a default, slightly woollier, if you like, and a likely impending restructuring. Obviously, that kind of putting that back on your own interpretation of what impairment is, of what a non-performing loan is, and those definitions of impairment, that casts the net an awful lot wider. And there may indeed be in that NPL asset class sort of bucket loans which haven't missed any payments, that aren't delinquent, if you like, at all, but they still may be classified as NPLs. Hopefully that's shone a bit of light into what is otherwise a kind of a murky area, I must admit. Maybe if we set the scene a little bit further, Alessia, if I can come to you first. The view from your own personal view, but also the view from DebtWire on NPL and non-core, if you like, sales in this year, 2020 versus prior years. What's been the focus in terms of jurisdictions as well when we talk about the stock of NPLs being sold, being moved in the market? If I can ask you, please, to please address that.
For sure. Thank you, Nigel. First thing, I think that we should address one question: why NPLs are important. There are recent studies, both by the ECB and by EBRD, showing that there is a correlation between the disposal of NPLs and the GDP and the resolution of a crisis. Obviously, we are in the midst of a crisis, and it will be interesting to look at what are we going to do to fix what's clearly a restarting NPL problem. Why there is an NPL problem? Because as my point of view is DebtWire's point of view, I'm a journalist there and I write about NPL deals there. We put together a quarterly report showing all the activity across Europe. We just published a report last week for the third quarter. For this quarter, we are seeing particularly two important things. First, it's connected what I was saying before, the level of NPLs. Since 2014, the level of NPLs across Europe has going down. Peak level was 1.2 trillion euros across Europe. This level is going down due to disposals, due to regulators' efforts, etc., up to reach a record low of about 522 billion across Europe in March of this year. The thing is that this is changing right now. It has already changed. According to the latest EBA's data, we see that now we have about 526 billion in the European banks' balance sheets. We're talking only about a 4 billion of difference. Yes, I'm checking the number, it's correct, between 522 to 526, 4 billion of difference. But the important thing is that this is the reverse of a trend that has going on since 2014. And this is due to the COVID-19 crisis. Obviously, it is due to the crisis because we can already see stress that's impacting banks' balance sheets. But also, this quarter has been different from all the previous quarters since, at the very least, 2016. I've seen data starting there, showing that this quarter has been the least active in terms of NPL sales since 2016. Sorry, I didn't mean this quarter. I meant these 3 quarters. So looking at the first 3 quarters of each year, starting in 2016, we saw that in 2020 there were 39.2 billion of volume of activity. And again, compared to over 60 billion in 2019 and about 149 in 2018. There is another important point going to your question about the geographies. The activity has been very much concentrated in 2 countries that were Italy and Greece. I think about 87.2% of all the activity, 87.2% of all the activity in the first 3 quarters of the year were in Italy and Greece. In Italy especially, there were deals for 25.1 billion, making it 64% of all the activity. In particular, this is interesting because Italy and Greece have been the most active countries in a while. The reason is that because their NPL level was still up since being a legacy from previous crises. But still, there were places like Spain, Ireland, Portugal that have been pretty active in the past 2 years. This has not been the case so far this year. Again, why this is important? Because we know that banks will be impacted by a new wave of NPLs, and they still have to address legacy NPLs from the previous crisis. So the fact that the banks are not selling in certain areas of Europe can be a problem down the line.
I think that's exactly right. And Eric, we were both on a round table 3 weeks ago or whatever it was now, the end of September, where it was quite obvious that certainly the regulators in the European space are fully aware of the fact that the potential stock of NPLs within the banking community is on the increase. As Alessia has pointed out, sales have dwindled to a trickle, more or less, in comparison with previous years, and it's fairly obvious, given the current environment, that actual NPL ratios will only be on the increase. It's high on the agenda, isn't it, Eric? And that was definitely very much part of the message which came across during that roundtable and the subsequent roundtable that you took part in.
Yep, exactly. Maybe it would be useful to build on what you explained on the NPLs and what Alessia just mentioned. Just provide a bit of a background of the thinking of the European regulator in that respect, and where we stand today in terms of new thinking for the 2.0, let's say, of the action plan. As we all know, the 2008 crisis led to a large amount of NPL stock, as we just discussed. There was a big concern at the time that would create to failure of banking systems, as we saw in Cyprus, and potential contagion across Europe. So that has been taken very seriously. Stock accumulated. It was very difficult for banks to restructure, resolve their loans, sell them, and we were accumulating the stock like anywhere else in the world. So the European Commission really did a lot of work there with the EB and the ECB to publish an action plan in 2017, which there was a lot of measures in there, and I won't talk about that today, but really a lot of measures to help the banks to decrease the stock, so provision better, manage better, and allow to sell also, and also to prevent the accumulation of new stock in the future. So there's been a lot of thinking done there at the bank specific level, but also they introduced some concepts that are back on the table that I will come to in a moment. Broader concepts such as national EMCs. So they created a blueprint in 2018 on EMC blueprint, and also they published a working paper on the European platform to sell NPLs. So come back to that in a minute, but just in terms of what has been done until now, we've seen a big change and big improvement from the peak of the crisis, from 8% NPLs across Europe to 3% and less now. This said, a lot of banks still remain above 5%, which is defined as being high NPL banks. So a lot of banks are still struggling with legacy stock. And the crisis, COVID-19 crisis, unfortunately, is hitting the economy hard and is bringing a new level of complexity there. So these banks already impacted are potentially at risk. So as you mentioned, the European Commission, together with the other regulators, are back on the drawing board now to discuss more broader systemic solutions in addition to the regulatory toolkit that has been done and implemented until now for the crisis, such as the payment break and the guarantees. And now they put together two workshops, one for the industry that we were together on the 25th of September, where they presented some of these options. And on 5th of October, there was another one that I was part of, which was more with EU and national regulators and some observers as well, where they discuss, they brainstorm about the feasibility and the willingness also of some of the states to implement those. So I'll just highlight them very briefly, being conscious of time. but I want to touch a few of them because they're quite important. One of them that was mentioned was the asset management company. Some of you might have read in the news that there was plans to create a pan-European EMC by the ECB. This is not true, and neither that they want to create compulsory EMCs at national level. What has been discussed there is really how can we improve the existing framework, the proven framework, like where we created the NAMA, the SAREB, and all that, and build on the blueprint of 2018. And maybe create a more connected network of EMC across Europe to solve the issues of cost and complexity. They also discussed the EU transaction platform. Once again, there was rumors that Amazon-like platform would be created under the SRB or whatever it was. This is also not true. What was discussed there is how can we really leverage more the platform concept, either by leveraging the debitors of this world that Timur will jump in a moment, or how can we potentially create a data hub for Europe to help the bank share information, the regulator provide best practices, and potentially be a platform for these EMCs that we just discussed, or furthermore, maybe in the future, partnership with the private sector to work as a pan-European platform, but this is really down the line. It's not clear to me yet how that will work in practice neither. The EBA also wants their NPL templates that they created in 2018 to be more used by the industry. So there's discussion there on how to improve the operational attractiveness and simplify them. Securitization was another big topic. As you may be aware, there's changes now to the securitization regulation to be better tailored for NPLs. So hopefully that will help also with transactions. And last one that I just want to touch is the harmonization of insolvency and enforcement frameworks across Europe. This is still a big pitfall that we have in Europe because of all the different systems across the different jurisdictions. This is quite complex and a lot of pushback there by different states. But what's important is the EBA will publish in November its benchmark on enforcement frameworks, which can be useful for investors and banks to better understand how they stand. So a lot to be discussed, a lot more to come in next months. This is a really hot topic. More will come, as I said.
Thanks, Eric. Timo, you were part of that initial roundtable anyway on the 25th, I think, of September, along with a few other platforms as well. For the benefit of those who are watching who don't necessarily know what Debitos does, what your focus is, and your origins, and what your views are of potential solutions to the NPL and broader liquidity problems going forward. Could you give us a bit of a sort of a run through in terms of your views and what you presented as well during the course of that roundtable?
Yeah, sure. Thank you. I think we are happy that we can support here a little bit also the political discussion around this topic. We as a fintech company or a technology company, for sure we had not the target to solve a political problem when we founded our company. We saw this as a general trend in the loan industry, that there is more standardization and more the need also for investors to circulate money. So when the investor invests in someone, that he can also have the option to invest at a certain later stage. I think there are already a lot of industry initiatives, also Loan Market Association, and also a lot of primary issuance platforms to digitalize the loan issuance. I think it's a general or natural development that there is now a more push also for secondary platforms, so for existing platforms to exit investments. And for sure, there is a very big rising problems now for the banking industry because they are the biggest investors in loans. They have this not now on their balance sheet, and we expect here a much more active portfolio management in the future. So the banks have to get familiar not only to buy and hold the strategy that they might follow in the past, They have to make an active portfolio management, and sometimes even sell loans even before they're getting non-performing. And I think what is interesting on this platform models, the transaction platform models unites different working streams, data standardization, legal standardization, an exchange, and in a community a reference point. So you have one central point to exchange. And this is a trend, I think, that we see in similar industries, and it's also worse for the banking industry to digitalize this kind of process right now as well. As you might know, in the past, most of the transactions were executed as in some kind of OTC style, where people really do it bilateral or on negotiation base. And this can be now a big improvement, and we are happy that we get also this kind of regulatory push in this regards. And we are also convinced that this toolkit, this transaction platform, is another possibility, an option for the banks in the future, next to AMCs, next to securitization, to get them a very quick and easy option to exit an investment. I think there are different ticket sizes where we are more focused on. I see more the big ticket sizes of 2 or 3 or 4 billion in the space of securitization. The most of the portfolios between 500 million and 2 billion are mostly traded with advisory companies. And in the space below, I think there is a very huge area of possibilities for platforms to streamline and to make this process very easy. And this is also why we are supporting the idea, and we are also supporting the idea of EBA to push this EBA template into the market. It takes some time, for sure. It takes some feedback. There are always discussions like this in every industry when you push a standard into it. But I think now it's good that these points will be discussed right now, because for sure next year we see a big wave coming also on our side. We expect this in nearby all European countries. So even the ones that have never managed any NPLs, like Switzerland or even in Germany, the NPL rate was quite low. Although we had some bad banks, it was not so heavily hidden. But there are a lot of countries now having these kind of problems, and I think this is a good toolkit to provide here an option. And also maybe...
Thanks, Timo.
Yeah,
sorry,
maybe,
Timo, go ahead.
No problem, but maybe let me give us also some words to Alessia. Also, when we see this kind of transaction drop this year, it's not only in the market of direct sales from banks to investors, it's also in the market of managed or securitized portfolios to further transaction or further investors. It's a very complicated topic and situation right now for investors, especially also in the securitization market, to reevaluate all the portfolios and the business plans. I think they might also have problems in Southern Europe and also in Italy and Greece regarding GACS to meet all the business plans, because the credit servicer for sure have these kind of they have to warrant also the execution of the business plan. So we all hope that they find also a solution to not make this to not stamp this as a failed program at the end of the day, because currently also what we see, this kind of re-evaluation of the portfolios and re-evaluation of the business plans internally from banking side, but also on the securitization vehicles, has led to a big drop in transactions, because every seller and even each investor has a big uncertainty now about the purchase price or the right price for the portfolio.
Sorry, Nigel, if I may,
Yeah.
given that Timur mentioned the transaction, I think that's an interesting point. That's more anecdotal than with actual data, but some reverse or a little bit of an increase that we have seen this year is probably actually in secondary deals coming from securitizations, and definitely platforms have played a role in this type of transactions. We should also, though, consider that so far the total volume of deals going through platforms in Europe has been limited, but definitely in terms of the developing and increasing secondary market, they are starting to play a more interesting role.
No, I can totally confirm this. We also, on our platform, we have a lot of loans out of securitization vehicles right now.
Thanks both. Just to give a bit of a flavor for another market that you sort of touched on there, which is kind of that OTC bilateral market, Timur. Obviously, as I mentioned, the LMA is kind of born out of the early 1990s distress, sort of corporate distress scenario. But even today, we see something to the order of 15 to 20 billion euros nominal worth of trades per annum. That is in around about, say, 4,000 to 5,000 actual single ticket trades. So doing the maths, anywhere between, say, 3 and 5 million in individual ticket sizes. Those are regular every year. That's regular every year activity within that market on an OTC bilateral basis. I mean, clearly platforms are playing catch up, and it would be great, as I mentioned during that roundtable, it would be great to see liquidity enhanced by platforms proliferating within Europe, having more of that pie, if you like, together with single ticket OTC trades, which will remain part of the market, and complemented obviously by the larger ticket sales and securitizations that we've all been talking about. Inigo, if I can maybe come to you, Spanish lessons, for want of a better phrase. I mean, Spain was obviously very much impacted by the aftermath of the global financial crisis. One of the most active AMCs, asset management companies, in the form of Sareb, specifically with a focus, obviously, through the GFC, the global financial crisis, on commercial and residential real estate. It might look a little bit different going forward from here in terms of the mix, but nevertheless, what are your pointers and maybe lessons learned from your experience within the NPL space in Spain?
Yeah, probably. I mean, it's worth just to give you a very brief flavor of what happened and why we had a sort of a relatively particular crisis in 2009, which obviously everyone was hit by the real estate crisis, but in the case of Spain, it had some particularities, no? And the NPL market that was raised in Spain was really focused on real estate. It was it was probably one of the hottest countries, as Alessia was saying. Looks like we are getting there a bit slower than the other countries as Italy or Greece, but we really hope that the market gets back to normal and we get there again. No? So yes, I'm not going to make the full story because it's going to be very long. But what we faced in 2009 was a mixture of growth of GDP during the 10 years, very low unemployment. We had a huge banking system with a form of 55 entities, with the level of branches per person probably one of the highest in the world. A lot of the liquidity in the market, and this led also to a development or construction business that was really big. I mean, everyone wants to have a house in Spain. Spanish people loves bricks, and when you go to university, first thing you want to do with your money is get a house. Your parents will buy a house as soon as possible, and there are a lot of tourists that do have houses in Spain. No? So in years 2004, 2006, Spain was building something around 700,000 units per year. which was equivalent to those built in France, Italy, and Germany all together. So, we end up in 2009 with a sort of a perfect storm. The developers were really highly leveraged, and the banks were facing a really difficult situation, especially because half of the system was controlled by what we call the savings banks, which were entities controlled sort of by the autonomous communities and local authorities, which many times are not, I would say, business driven. No? So they had other interests. So with that in mind, what did we do? I mean, we faced a situation where the banks were having something around 300 billion in impaired assets in 2009. So the banks started to try to sell on an OTC, as you were saying, Nigel, to foreign investors that knew this business. And obviously the banks were trying to get sort of a par value or 90%, and the investors were offering 30, 40, 50%. So there was a huge gap there. And a key element is to be able to close that gap. How did we close the gap? Well, there were two main measures made by the government at the time. I would say with the help of the European Union, basically, otherwise they would have intervened stronger than they did Spain as a country. And it was to incorporate the Sareb. Well, first, to set up a level of provisions, which is something that has been the path since there, where you have to duly provision your loans with depending on the value of the collateral, which was not the case before in Spain. Therefore, the banks had to get a huge level of provisions to put the value of the collateral of the loans at that level and incorporate Sareb. Sareb is probably one of the, as you already mentioned, one of the main EMCs. It's an example. It has worked. To be honest, 50 billion assets were transferred to Sareb from the former savings banks. Sareb has a 15-year period, out of which it has consumed 8 years and have sold out of 50 just 17, just 13. Sorry, they still have 37 billion to sell in 7 years, which seems challenging. They have a very good team there, so hopefully they will do that, because otherwise, what they're going to do. And then what happened and the lesson that we learned very fast was that first the banks started to put teams on the deleveraging and on divestment. Second, there was a huge consolidation of the banking system, which is still continuing. Out of the 55, we have now like 8 banks. So the sound banks acquired the weaker banks, and with those mergers, they consolidated the bank balance sheets and were able to divest. And that consolidation again is continuing. Out of 8, we have 4 of them are merging between them. No? So that is key. And then when Sareb was incorporated, it put a benchmark, and then the gap really closed very fast, because banks assume that was the level at which they had to sell. At that time, we really started to get all the attention from the foreign investors, which came. We had a lot of portfolio sales in 2013, 14, and the rest of the years. And there's been around 350 transactions with value of 300 billion, with around 80 investors at least acquiring these portfolios. The typical guys: Blackstone, Apollo. Blackstone, for you to know, is the main lessor of dwellings in Spain. They have around 20,000 units being lent to Spanish individuals. What did the market work? And I think it's been mentioned by Timur. Is clearly that we were able to very fastly agree that the market had to institutionalize, to be standardized. Financial advisors have made a huge work in providing good data. Servicers, which were some of them acquired by the same funds that were acquiring the portfolios, are very sophisticated, not only in servicing but also in helping the funds in the underwriting process. probably lawyers, we've done our role. No, I mean, clearly we know very well how the SPAs have to be negotiated, what are the key terms, and you make all the process very efficient, which I think is key for this market to come back and to continue being an interesting market. That together with what Eric said, we need a strong and clear judicial enforcement and judicial courts, because investors need some certainty in terms of timing, and that when you go to court, you are able to enforce a mortgage. It may take longer than what you expect, but at least you have a framework and you know that you are going to get an asset if that's what the strategy is. So that's more or less how I see what happened in Spain, and which hopefully is a history of success again.
Well, I mean, on that, I mean, you mentioned the sort of judicial framework, and obviously the landscape, if you like, Inigo and Eric, to both of you, the landscape in terms of insolvency laws are changing, and have been, well, certainly under discussion for quite some time. Is it a change for the good? Will it be universally accepted? Will we see potentially, maybe an impact, a positive impact on the stock of NPLs not being maybe as great as we might have thought? A way to work for incumbent lenders to work through rather than sell out. Inigo, Eric?
Well, I mean, if I may, and Eric, please complete what you think. Just for you to know, there is a European directive that was approved last year and that has to be implemented before July or June 2021. And so most of the countries are in the process of incorporating the directive to their insolvency regimes that basically procures the early preventive restructuring. So this is that, mainly in Southern European countries, insolvency 95 of the times means liquidation. So that's what they try to avoid, that you don't need to get to insolvency and prevent situations so that they can be restructured before filing for insolvency. Let's see how this plays out, because it has to be implemented in different insolvency systems. I know Germany is already approved, and I think France too. And Spain is in the process, but it will take a few months yet. But it's good that there is a sort of an harmonization of the rules between the different European countries. Definitely, that's key. Yeah.
I also think it's extremely important to have, especially the preventive measures and also harmonization across Europe. This said, I think there's been pushback in the last years. We've seen it in different jurisdictions. And in the same countries will continue to push back. It's often highly political as well, which is difficult to change, especially when you start touching the retail part of the world. So I'm not expecting to see miracles there, but hopefully there will be enough harmonization so that if there is a platform, things like that, people can understand, and American investors can understand actually how it works overall. With little tweaks maybe, but you don't get 27 different, completely different regimes.
Yeah, can I maybe say a word from Germany?
Please do.
Just made a draft, and what they are planning now to realize it on the 1st of January, all payment moratoriums in Germany are ending at the end of this year. So they want to avoid, especially this situation that all are getting to insolvency at the 1st or 2nd of January. So what we expect is some kind of restructuring phase, as Inigo mentioned, and there will be more an investment, a new investment basket for a distressed investor. It's very similar like the UTP investments you have in Italy, where you have companies that are not non-performing, but anyhow, investors know that they have to review a lot of restructuring situations. But it's also a good chance, I think, for the companies. So we see it very positive. Yeah. And I hope also the other countries will follow. I think the first ones were the Netherlands, as far as I know.
Yes, I think you're right, Timo. Just mindful of time, we've got 5 minutes to go, and clearly we need to cover off predictions. If we can all get maybe our crystal ball out, in terms of, how things are going to progress. I mean, clearly, rating agencies this year have come out with potentially numbers which might suggest a default rate in the corporate sphere, well, non-investment grade corporate sphere anyway, of maybe double what we would have expected or what we saw certainly coming out of the global financial crisis. High single-digit numbers in that corporate space, married with potentially a higher loss given default, which is obviously not a particularly rosy picture to be painting. What do you guys think about the into the second wave? We're already into the second wave in just about every country. We were discussing before we went live about the current situation in Madrid and in Frankfurt. And obviously it changes every day, quite frankly. What do we think about predictions into the second wave for NPLs, for continued focus, potentially for increased sales, and beyond, because I think this situation is going to be with us for quite some time. Alessia, if I can come to you first with that.
Sure. I don't like to do predictions. I just try to see what has happened, and I can tell you what we are seeing that's happening and that's working. In Italy, we spoke about AMCs. In Italy, the AMC AMCO is playing a major role. This year, they bought about 11 billion of value of NPLs. They will keep playing a major role in the cleaning up of banks' balance sheets. The other thing that's working, and I think that would deserve more space in the conversation, is the scheme of securitization with state guarantees. In both Italy and Greece, now there are these two tools available that allow banks to securitize NPL portfolios and to have this guarantee from the state on the senior notes. This way, they have to sell mezzanine and junior loans to the market. So it is, and then they retain, in most cases, the senior with the guarantee. It's a win-win situation because the banks are deleveraging the risk of NPLs, but at the same time, they are selling on the market and market players are involved. So for the past few years, we have seen securitizations having an increasing role in NPL disposal. In Italy, especially, they have played a major role. We have seen over 80 billion of disposals since the starting of the program in 2016. In Greece, the program has started. It was approved in December 2019. So we only saw one closed deal so far, but all the banks are working on it, and there are about 23 billion of deals ongoing in Greece. Mostly will be part of the securitization scheme. So a lot of conversations in the market is why not to expand such a tool to other countries that will face an increasing level of NPLs. Because again, to your question, how big will be the next wave? We have no idea. It's happening, it's coming. What's the best way to address it? Clearly, every tool available will be a useful tool.
Agreed. Inigo, your thoughts on that?
Yeah, very much agree. I think that in Spain, we really expect something that we didn't have in the first crisis, which is a corporate NPL market. Corporate NPLs were very few and very little and mostly done on a bilateral basis. But we really think that, corporates, unfortunately, are going to get hit. The Spanish banks do still have a huge exposure to non-performing loans, not recognized in their balances, that will need to be addressed with this crisis, because there's been a lot of refinancings granted with the state government guarantee due to COVID that, we know those are not performing. and those will come to the market next year. So we see that, and we see also opportunities on the secondary market. There are investors that keep selling and that will continue selling probably next year. The tails or parts of the portfolios they bought in the previous years.
Thanks, Inigo. Eric, if we can come over to you.
Thank you. Well, also, like provision, I think prediction are quite difficult, but what I see with bank preparation to the flow of NPLs is banks are really focused on the short term now, coming out of the payment break. All the analysis for most banks have been done on that, quite at the high level, industry level as well. So they understand very well where the pressure is coming in the short term. I think in the medium to longer term, there will be surprises there, as we said, in corporate SMEs. And banks, unfortunately, in some jurisdictions, have not prepared enough to avoid the value erosion and do forward flow strategy planning. So we might have stresses, not just on NPLs, but on banks in these jurisdictions, which are already pressured with legacy stock and low profitability. So potentially also more consolidation in the banking sectors and resolutions as well of some of the banks. But my view.
Thanks, Eric. Lastly, over to you, Timo. Proliferation of platforms, growth in your business, partnerships. What do you think?
Yeah, for sure. We want to provide this technology to different market players. I think we have made a big step forward in the Italian market, where we have made a cooperation with, for example, doValue Group, a big loan servicer, but we are also capable to provide this technology to advisory companies or bad banks. So we see a push here. We see also, I share the opinion also with Inigo that we see the first hits already in the corporate loan market. What I have a little bit of fear of is hopefully not everything will happen in the first quarter 2021 after an unregulated Brexit or whatsoever, because this can really collapse a little bit the financial sector. So hopefully it will drip a little bit in the next year, so from quarter to quarter, not everything in the same quarter, because this can hit the system very hard, I think, when there will be, because every county I know have the payment moratoriums, and most of them are ending this year. So, when everyone is going into bankruptcy at the 1st of January, it can be tough, yeah. Then hopefully it won't be like this.
I thought we might get through an entire session without actually mentioning Brexit, but you managed to fit it in there, Timo. Well done. Listen, we're out of time. All that remains for me to do really is to thank my panelists. Alessia, thank you very much indeed. Eric, Inigo, and Timo, thank you. And thank everybody for watching. Thank you.
Thank you.
Thank you.
Thank you.